Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. So, Matt, we got some news crossing the tape here. JP Morgan settles with Staley, US Virgin Islands, to end Epstein legal woes. JP Morgan Chase reached settlements with former executive Jess Staley and the U.S. Virgin Islands over ties to Jeffrey Epstein as it seeks to end its legal woes over its banking relationship to the deceased pedophile. The biggest U.S. bank tentatively agreed to pay $75 million to the U.S. Virgin Island. That's according to the statement Tuesday, less than half of the $190 million of the territory it sought. So let's kind of break this down a little bit, and we can do that with Elliott Stein. He's the senior analyst of Bloomberg Intelligence, following all the legal issues for BI. Elliott, I guess this, if nothing else, does put an end to kind of what JP Morgan sees as a very bad part of its history.
Yeah, I mean, this has been a sordid saga ever since Epstein was arrested. And then late last year, you had both Deutsche Bank and JP Morgan sued, both by the victims, Epstein's victims, and then JP Morgan was also sued by the U.S. Virgin Islands. Both banks settled with the victims previously, and now we have this settlement, which should put an end to at least the litigation against the banks.
It's unclear what the settlement with Staley looks like. So we know that in terms of the U.S. Virgin Islands, the bank has at least tentatively agreed to pay $75 million. They're not admitting any wrongdoing, I imagine, but when you fork over $75 million, that says something in itself. In terms of Staley, I don't get whether this means that he is going to pay them, and certainly they haven't released any terms.
Yeah, I mean, presumably there's some sort of monetary component to the settlement between JP Morgan and Jess Staley. They were
coming from Staley to JP Morgan.
Right. JP Morgan was, they were saying that they were really only on the hook because of Jess Staley's involvement with bringing in Epstein into the bank as a client, and that as a result the bank was, vicariously liable because of his actions. And so they went after him for a few things, breaching his duty to the bank by not telling the bank earlier about what was going on, and then seeking any contribution for any payout that JP Morgan was going to make.
Well, for convincing them to keep Epstein as client. Everyone knew what was going on. I mean, the prosecution and his conviction in, 2008 was public knowledge. So everyone knew.
And that was the problem for the banks, that there were red flags. I mean, there was no, concrete evidence that he was, doing sex trafficking with children. But there were enough red flags, part of which was because he had a prior conviction.
All right. Deutsche Bank also paid, didn't they? I seem to remember them being involved.
Yeah, so Deutsche earlier this year paid about $75 million to the class of victims that had sued Deutsche. JP Morgan also settled with that class of victims for about $290 million. And that was earlier in the year, in the spring and in the summer. And then this case, the U.S. Virgin Islands case against JP Morgan, was going to go to trial in October. So actually, I wrote just a couple weeks ago that it looked like this case was on the path to settlement because neither side wants to go to trial in a case this salacious.
Yeah, it's the last thing if you're JP Morgan you want to have, and then have Jamie Dimon dragged into this.
Exactly, right. These are not facts anyone wants to come out in court.
So I guess from JP Morgan's perspective, is this issue behind it now?
I think so.
Because you settled with the victims, or the class of victims, I guess, right?
Yep.
And if you didn't join that class, do you have any standing to come back and try to do something again?
No. The settlement is like you either opt into the settlement or you don't.
Okay.
Well, they were sued by this class of victims,
right?
And they were sued by the U.S. Virgin Islands,
right?
Who knows if some other group will come and sue them as well?
Yeah, it's hard to envision what group that would be, and there's always statutes of limitations too, which sort of put a cap on when lawsuits can be brought. So at this point, given this resolves everything that's out there right now for JP Morgan related to Epstein.
All right. That's interesting news just crossing the tape here, so we want to dive into it and see what the impact will be for JP Morgan. But I guess if nothing else, it puts that legal issue behind them. Elliott Stein, thanks so much for joining us. Elliott Stein is the senior analyst with Bloomberg Intelligence. He went to Stanford, so that's Pac-12, right? You're Stanford, you're Cal, all that kind of stuff.
Yeah.
Guess what? that Stanford Cardinal now have to come to the East Coast because they're playing in the ACC going forward. How stupid is that?
Well,
Yeah.
they're coming closer to me, so I appreciate it.
It's good for you, I
It's
guess.
good for me. I can see more games.
But it doesn't make any sense.
It makes no sense.
Historically.
So I'm going to ask the volleyball team, some of these young ladies, to travel 2 days to get here, a couple of days, 2 days to get back for a volleyball game against NC State.
And
Well,
you think
dude, they're
the
not
East Co-
driving.
And do the East
I
Coast
know,
teams
but
want to go
still.
to the West Coast? Probably
I know.
not.
I always see these kids in the airports, these teams from all these schools, and there's it's not like the football team where they get their own chartered or anything. The basketball team, it's the volleyball team, it's the soccer team, it's the golf team or whatever, and they're always like sitting in airports, huddled up, trying to study and everything. I just can't imagine this cross country stuff. Of course, USC and UCLA. They get to come to Piscataway, New Jersey, to play Rutgers. How good is that? All right, Elliott, thanks so much for
Thank you, guys.
joining us here.
You're listening to The Tape, Cantor Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Definitely a risk-off feel to the market here today, again, as the high interest rate environment seems to be here for longer is what the market's pricing in. Let's check in with somebody who has an informed opinion on this. Brent Schutte, Chief Investment Strategist for Northwestern Mutual. Brent, what's your call here on what our Federal Reserve is going to do kind of over the next 6 to 12 months?
Yeah, I think the Federal Reserve is worried about wage growth. So you have seen the disinflation that we thought would happen. That was largely because the inflation that we had over the prior couple of years was largely tied to COVID. And as we pushed further past that and the economy moved back somewhere towards equilibrium, we thought that inflation would come down, and it has. That's the good news. The bad news is the US economy looks late in an economic cycle. What typically happens late in an economic cycle is that the labor market is tight, which causes wages to grow. And that can lead to inflation being pulled back higher, which I think is the prime worry right now. And so until the Fed sees wages move lower, they are not going to take that liquidity tourniquet off. Unfortunately, the only way that wages have moved lower in the past when the labor market's this tight is through job losses, which we think is a likely outcome in the coming months, which will lead to that recession that we still think is on the horizon.
What do you think about the UAW strike? And, if they come back with wage increases, they're going to be at least 20%, right? Maybe closer to 30%. That's, I guess you could say, only 150,000 workers, but people at other shops are going to look over there and say, I want that too. Is that going to be a real factor, or do you not expect it to have kind of a nationwide effect?
No, I mean, I think it's more indicative of where we are in the economic cycle, which is late, where wages rise because there's a lack of workers to fill open positions, which causes that wage growth that the Fed fears about. I think people forget that the inflationary period that the Fed worries about that was so bad in this U.S. economy was called a wage price spiral. And that's where I think we're at right now. And that's why I think the Federal Reserve isn't going to stop. They're not going to loosen policy until they see wages pull back. Right now, wages are running at 4.3 to 4.5%, pick your measure. I think in an interview a few weeks ago, John Williams, VP of the FOMC, said that 3.2 to 3.5 was more consistent with 2% inflation. And as I mentioned before, the only way that's happened in the past is through a recession. And so maybe this time is different, but I think there are enough things that are flashing red that you can continue to think about that recession coming in the not too distant future.
Well, if that's the background there, Brent, are you advising folks to just go into 2-year treasuries at 5.13%? That doesn't seem like a bad place to be.
Well, we have been repositioning towards fixed income for the better half of the last 6 to 9 months. And so we are overweight fixed income and underweight equities. As far as hiding out in the front end of the curve, I would advise people not to do that. I think intermediate term bonds offer value here. They offer a hedge against equity downside risk, which I think will be caused by too little economic growth, which will cause inflation to fall. And so if you think about your Bloomberg aggregate index at 5.35% and a 6 duration, if inflation does fall, think about the difference between 5.3 and 2%. That's where I think there's value right now, especially if you believe, like I do, inflation is set to falter, which I do. I think the good news on the opposite side of that is the Fed will be able to cut rates, but not until they actually see that actual recession happen, which I think is still on the horizon.
How far out the curve do you go? Did you say 6 years? I mean, I know nothing about bonds, like Paul. But I look at 4.85% on the 20-year, and I think, when's the next time I'm going to see that?
Yeah, this is where, so maybe just a little bit more commonsensical. So if you invest in a 2-year right now, so let's take you back to 06 and give you a real life example. In 06, the yield curve was inverted. I believe the 2-year was somewhere around 528. The 10-year was at 524 or something. So it wasn't as big as an inversion today. But think about that person in the 2-year. Think about something called reinvestment rate risk. They would have had to reinvest that 10-year or that 2-year 4 more times. The first reinvestment, I believe, would have occurred sub 2%. The last 3 sub 1%. And so that's where I think just having bonds across the spectrum for an individual, I think is the most appropriate thing. I just worry right now that people are hiding in cash. And you're right. Who knows where rates will be 2, 3, 5 years from now? Perhaps rates are higher now. I don't think we're going back to where we were before, but that's still a kind of an uncertain call. And I think that's reflective of, if you think about uncertainty, you probably want to spread your bond across the curve just a bit and not hide in any one part of the market.
So on the fixed income space, go out a little bit. And is it really, are you staying with investment grade, or are you considering certain parts of the high yield?
No, not high yield yet. I mean, investment grade right now, given that we're headed into an economic contraction, I think you want to stay high quality, especially when those investment grade bonds offer quite a bit of yield. In many cases, yields you haven't seen in 16 to 20 years, which I think, 4 years ago, if I'd have came on your show and told you that, you would have told me I'm crazy. And so that maybe isn't a little bit of a commentary about how uncertain the world can be. And that's where I think, I think people need to reflect that. And I think you need to invest across the curve, but focus more so on intermediate term bonds, just given the fact that you do lock in those yields for a few more years.
When is the right time to buy high yield debt? I mean, if you see a recession coming next year, do you buy in the middle of it, at the beginning of it, at the end of it? When?
Yeah, I think somewhere around the middle of it. I mean, that's where I think, and that's where it's kind of uncertain about timing. There are many indications to me that the U.S. economy is headed to a recession. I think people are ignoring them because they believe this time is different. There are so many things flashing red right now that, I think a recession is probably, it could happen in the next 3 to 6 months. That's where timing is a bit uncertain. But that's where you just behave better at the end of an economic cycle. And that's where I think you want to be in high quality bonds now. I think the time for owning things that are less than high quality is after they reprice quite a bit, which they haven't done enough so yet.
By the way, I got another credit trader writing in with a question. Since buy rates is sort of consensus decade high yields, how do you outperform your peers if everyone's doing the same trade?
I'm not for sure that is consensus any longer, or is consensus. I think that, the soft landing trade was on the higher forever in interest rates. When I talk to individual investors, they are scared to buy bonds. And I don't think you're seeing a huge rush into the bond market. I hear enough other voices of people like myself who are telling people the opposite, which I think is the wrong answer.
In equities, I mean, the big cap growth stocks have been the winners here this year. Do you stick with them, or do you try to find some value elsewhere?
I think you try to find value elsewhere. And this is where my commentary about liking small and mid is a bit odd, because they are more economically sensitive. And this is where I do think there is some good news for equity investors. I think parts of the market have discounted some sort of a recession. And so if you think about most of us on Wall Street, we do have to put money to work every day. And so I think most people have hidden out in those large cap names that they think are economically insensitive and that they're going to grow forever. And that's been the part of the market that has done well. Other parts of the market haven't. Those are small and mid cap stocks. The S&P 600 trades at 12.5 times forward 12 earnings that are down 12 to 13%.
Yep.
And so I suspect that you will see those earnings estimates fall a bit, but I do think there is some cushion there. And that's where I think the opposite side of this can be really good for individual investors in those areas. All
right, Brent, thanks so much for giving us some of your time. Really appreciate it. Brent Schutte, he's a chief investment strategist at Northwestern Mutual. I appreciate getting his thoughts here. On the equity side, a little bit underweight and overweight on fixed income.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Matt, we've been talking about this strike against the auto workers that doesn't appear like they're making much headway. One of the questions I have is, how long can these auto companies go with this strike from a financial perspective? Joe Levington joins us. He's the director of credit research for Bloomberg Intelligence. He covers the auto companies from the credit perspective. He joins us live here in the Bloomberg Interactive Broker Studio. So, Joel, how are their balance sheets? How strong are these auto companies from a financial perspective? Because at some point, the strike's really going to hurt them financially, potentially.
Oh, 100%, Paul. Eventually they all have to get to a table and have to come to an agreement because everybody needs to make money, right?
Well, they only have to have more money than the UAW.
Exactly.
So how does their balance sheet look compared to that of the United Auto Workers Union?
They're significantly stronger than the UAW.
Okay.
It's combined, Ford and GM have about $90 billion of liquidity. Stellantis, I think, has about $70 billion of liquidity.
So liquidity for you is like cash on the balance sheet plus some bank lines that they can draw down on. So if I need cash, how much do I really have? And they've got like $90 billion, you're saying.
That's what I'm saying.
Okay.
And Stellantis has like another 70. So you're talking about $160 billion of firepower.
And the UAW has
$825 million of cash.
Oops.
That's what I'm trying to say.
Yeah.
I mean, if you were on the DraftKings app, you'd probably vote heavily that the autos can, last a lot longer than the UAW can.
And they haven't even really struck where it hurts, right? They hit them at a Bronco plant. That's bad, because there's already a long line of waiting for Bronco. Oh, they're awesome. They hit the Colorado, and I know, Mark Royce loves those mid-sized pickup trucks. Actually, I drove one. And I was really impressed with the turbocharged inline-4 engine.
Because you're an inline-6 guy.
I like an inline-6. Sure. I like a V8, but this small engine I thought was super punchy, had a lot of torque. Anyway, they hit them, the Wranglers, high-margin vehicle, but they haven't hit them on the truck lines, which is where it hurts, right? They haven't struck where they make the F-150. They haven't struck where they make the Tahoe and the Suburban. And that would be pretty hardcore if they did that.
It would be, but it goes both ways because the more people you put out of the plants, it also means the more they're draining down that $825 million, right? Because they're paying them while they're the UAW is paying their their clients while they're while they're on strike. But I agree with you. If you look back to times like the pandemic, right? The pandemic, really what you saw was about a $10 billion swing in cash flow over a couple of quarters. If you're talking about a Ford or a GM. So you could kind of get into that range, like if this protracts into, like a 5, 6, 7 week kind of event. But we're not there yet. And I think, while you have this time, both sides are going to haggle out for each percentage increase in salary that they can get.
How are the bonds? How have they been trading?
Bonds really haven't moved all that much because the raters have been done actually a very nice job of being very public about how they don't expect this to be impactful and how they've built in somewhere between 5 and 8 weeks of flexibility. So now that we're, just getting towards the low end of that range, there's still plenty of room in terms of how they're thinking about ratings.
So we came out of so GM and Stellantis, they did go bankrupt during the great financial crisis.
Chrysler is really what you're talking about, right? Stellantis is essentially a French company that bought the Italian company that bought Chrysler for like $1.
It's a mix of Peugeot, Fiat, and Chrysler coming together.
But I'm going to guess where you were going with this. So we talk a lot about the fact that the unions took a crappy deal in order to help support the automakers post-financial crisis. What we don't talk too much about is that the unions had a much greedier deal that kind of pushed these automakers into bankruptcy during the financial crisis, right?
Yeah, we're still talking about, I guess Mary Barrow is out there saying that we made an offer worth $115,000 a UAW worker that was rejected. So whether you view that
that's their final pay, $115,000?
Right, that's your take-home pay. So whether you are, depending on what side of the coin you're on, whether you think that's good or bad, it doesn't sound particularly horrible to me in any way for a unionized manufacturing facility. But
I'm just dividing. So Mary gets about $25 million. So divided by 115. So she still gets 217 times more than that.
Yeah.
And she works hard, I'm sure, and she's steered the company through some tough times. But she's had their help.
Yes, and that's what I say. They eventually have to come together because they both need each other, right? If you're going to make money, you have to have workers, and if workers want to have a salary, that they have to have a profitable company behind them.
Now, they don't just want a salary, right? Mary has a defined benefits pension plan.
Yes.
Are the workers going to get that too?
Well, Ford seems to have caved a little bit on that front, Matt. That's a really difficult front for others to go into, because if you think about GM, I mean, their OPEBs blew up to like $70 billion before they went
OPEB?
bankrupt. I'm sorry, Paul. There are other pension liabilities that are on their balance sheet.
Okay.
That's really what drove them into bankruptcy to begin with, was to get rid of those liabilities. So to start bringing them back in, I think would be a really difficult thing, and probably one of the bigger challenges on the GM side. Whereas Ford, which didn't go into bankruptcy, seems more open to working with the union in that aspect.
So if I'm a creditor if I'm a bondholder of the big three auto companies, do I have a threshold where I don't want to see them have it increase more than 25%, 30%, or do I just not really care? I just want to get a deal done.
The pay part probably doesn't matter, right? You care about the pension.
I think you care about the pension first. When it comes to pay, when you're talking about these increases between 20 and 40% are kind of, like where people are targeting. Even if you think about 40%, it's 40% of 4% of your total cost, of your total bill. And that's before there's any cost benefits that the company may get. And that's before you think about pricing.
So labor's only 4% of their cost structure?
It's only 4%.
So
it's
what's a big deal? Just
that's what two guys from Summit might say.
Yes.
But why don't you just call it 30 or 35%, have a drink and move on with life. And then you'd be fine, because really you're talking about a percentage point or two on your price side, or figuring out some cost benefits on the way, and then you can move on with life.
Yeah, but pensions are much more expensive.
Yes.
They also want a 4-day work week, which means you got to hire a whole bunch of other people and pay more health care benefits to those men and women. Plus, they want to know which products are coming. So, for example, Dodge doesn't have anything coming next year, and they're going to cancel a couple of their offerings. Chrysler only has the Pacifica minivan and nothing else.
Right. It's a good thing that the UAW is not at Bloomberg, because we love a 7-day work week here. I don't know what a 4-day work week would actually look like. It makes no sense to me.
I'm a fan of a 4-hour work week, frankly.
But clearly that's not going to happen with the auto workers. That's just thrown out as a starting point. But yeah, you're totally right. It's the full package, and it's really the benefits side that I think is more of the sticking point for a GM or a Stellantis.
So how do you think this plays out, having listened to both sides and all three companies?
Yeah, I mean, I think, Paul, we probably wind up somewhere that two Summit guys could figure it out over a cocktail, is that it'll probably be somewhere in the 30% range of a salary increase. You're going to have your 40-hour work week. Maybe there's some marginal benefit that they give back on pensions, and that's about where it'll wind up. And the reason that it's not that relevant to a credit person is because when you think about that increase, you're talking about 30 or 40 basis points of margin. It's really not that big a deal for the autos and their outlooks for the long term.
All right. We'll see what kind of deal they can get done.
You're listening to The Tape, Kantar Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Definitely some concerns out there in the credit markets, but one area of a positive sign, we saw Standard & Poor's Global Ratings on Wednesday upgraded the government of Jamaica's long-term foreign and local currency issuer default rating from B+ to BB- with a stable outlook. It is the best credit rating that Jamaica has received from S&P since it started rating the country's sovereign debt in 1999. Some good news there. We're going to break that down with Senator Aubyn Hill, Minister of Industry, Investment, and Commerce, member of the Senate of the Government of Jamaica, joining us live here in our Bloomberg Interactive Broker Studio. Minister, welcome to Bloomberg. What drove the increase in the rating outlook from your ratings issuer for Jamaica?
If I could put two words, it's disciplined management. We took over in 2016. The Andrew Holness administration took over. We made a commitment to the IMF at the time that we would continue to make sure we become fiscally disciplined. Right through that period of time, we moved our debts down from the high, as you might recall, at 147 when we took over, must have been in the 135 or thereabouts, and move it down to where we are today at 77. And going in the direction of 60, we had planned to get there by 2016, the pandemic interrupted. We moved it to 2018, but we might get there before 2018. And all through that, we've gone through the pandemic, spent 100 billion Jamaican dollars we didn't plan to spend, haven't borrowed any money, and we haven't raised taxes in 7 years. So that kind of fiscal discipline, the rating agencies have been watching it, and the best rating we've ever had in 24 years of S&P, we've just had the rating upgrade. And of course, we're not happy with that. We want to continue to make sure that gets to investment grade as quickly as we can.
So what are the industries that are driving this or supporting this growth? I have been going to Jamaica my whole life. We go to Silver Sands and Trelawney, and if I get a good bonus, then I'll spend a couple of days over at Rose Hall. It's a little pricey, but so tourism obviously is I would guess one of the main industries. What else is pushing this? Because Jamaica is not an offshore economy. This isn't somewhere where people go to hide money, or to start crypto businesses.
No, that's not what we do.
Yeah.
What happened is when tourism took a dip, and somebody who you've had here at Bloomberg many times, Ed Bartlett, found all kinds of innovative ways to help us open back tourism as quickly as we can. So that didn't stay down too long, and we're now back this summer well past what we were in 2019 before the pandemic. But through the pandemic, we had the BPO, the business processing outsourcing business, the knowledge outsourcing business, and that grew by 20% per year in the last 4 years. So we quickly moved to work from home, made the adjustments because under the BPO arrangement and OECD watching, you have to make sure you follow certain basic rules. We got those fixed with the Minister of Finance and through myself. I was then in the Ministry of Economic Growth, which is the Prime Minister's ministry, worked it out, got it to work, and it kept on growing and it keeps on growing. But we also are looking at growing our exports because we have had, just like we had a long period of bad debt situation, we've had an even longer period of negative trade balances, and we're now grappling our hands around that as we've done with debt and that's one of my main focus. Why I'm here with 20 odd 30 businesses to look at new markets and develop new markets, because you cannot be an exporting business and stay in your office.
Right.
So I take them with me. I took them here, took them to Atlanta. I'm going to London from here to make sure we develop the markets that we have and then wider field.
What are some of those markets that you'd like to develop, or some of those products or services that you'd like to develop?
For instance, you know Goya very well. We have something called Aki. Matty would have had Aki for breakfast in Jamaica.
With my eggs.
Okay, with your eggs. Looks like eggs. So we know, Goya said to one of our importers in Florida recently, we want 20 40-foot containers. They could only give them one. They want something we have callaloo, which is like spinach. They want breadfruit, which is we make into flour, and it's gluten-free, which people want. We want containers of that. So we have markets. While I'm looking for new markets, what I'm looking for as well, the Ministry of Industry, investment is the second part, and commerce. I'm looking for investment to fit those markets. Come in, help us grow our agriculture, process it, and make sure we have the markets for you. Come invest. So that's part of the message I bring as well.
What about cannabis? We talk about the cannabis business here a lot. Obviously, the legalization across, for recreational use, 23 states in the U.S. has grown the market, the legal market, considerably here. Can that be an export from a country that's, in a way, famous for Bob Marley and that sort of product?
We have exported to places like Australia and Germany, but you probably need to get to 38 states, at which point you can change the constitution, because it's a Schedule 1 drug, and until the feds change it, you can't do interstate banking. So you can do all you want in Colorado, but you can't ship it to California. So until that changes, as a Schedule 1 drug, we have to abide by certain international rules that we've signed in treaties. So we can't just export it willy-nilly, and we can't export it to the United States or even use your airspace to export it.
What is the political climate like in Kingston? I mean, we have here a very partisan, very divided political system, which is driving Moody's to threaten a downgrade. We've already had downgrades at Fitch and S&P. So what advice can you give to the U.S. government, post-upgrade, to try and get along and govern correctly?
Why don't I tell you what we've done? We have made sure that we focus on the fiscal part, because I noticed why Moody's is threatening to downgrade. The same reason S&P did in 2011. It's from what I've read, it's the fractiousness over the government closing down. Well, we can't say anything about that, and you have the privilege of having the reserve currency in the world. So you're in a very particularly privileged position. But what we have done in Jamaica is, if we didn't get, I remember when the IMF came in 2013, I was in that meeting, called at the University of West Indies by Oliver Clark, who I know you know.
Yes,
from
Silver Sands.
From Silver Sands. Oliver called that meeting. I remember the Governor Bryan went at the time saying, we cannot get our currency and our inflation under check unless the government gets its fiscal house in order. You will never hear or know, we've made the Bank of Jamaica independent. You will never hear the governor of the central bank talking about the fiscal position of the government, because we've put it under control. And until you get that done, then the rating agents will have that discussion. But frankly, your discussion is quite different because you're the reserve, you hold the reserve currency and the biggest military in the world.
Minister, talk to us about the economy today in Jamaica. What's it like for the average Jamaican today?
The average Jamaican, first of all, we're just recently, most recent figure we had for unemployment is 4.5%. It's the lowest in the history of taking numbers in Jamaica. So we have a historical low in unemployment. In the emerging market, 4.5% is near to full employment. So what's happening? People in the knowledge outsourcing business, the hospitality business, the tourism business, saying, and the construction business, we want people. 70 to 80% of our university graduates are women. We have 300 or 400,000 young people on the street who tend to get into gangs. They're men, primarily men, because they're the ones who weren't graduating. So now we're saying, we have Hard Trust NTA. We're investing money to take them off the street, put them in a training center for months, pay them a stipend. A part of the stipend, we use to open a bank account. We give them a national ID. We give them a passport, driver's license, so they become part of the citizenship. We give them the discipline, certify them, so they could work in Jamaica, the United States, or Saudi Arabia, and put them back in the workforce. So we're expanding the workforce in this vicinity, but with apprenticeship with skills.
All right. That's good news. It's a good story. The Standard & Poor's certainly think it's a good story. Jamaica upgraded its credit rating. Senator Aubyn Hill, he's a Minister of Industry, Investment and Commerce. He's also a member of the Senate in the government of Jamaica. We appreciate getting a few minutes of your time.
Great to have you here. Thanks so much for joining us.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Gary Shilling from A. Gary Shilling and Company has darkened our door. And Gary, we've seen an incredible rise in rates over the last few weeks. What is going on here?
Well, I think there's a conviction that the Fed is not through tightening, and I don't think they are. They really are determined to get inflation back to 2% and to keep it there. And of course, they were very much behind the curve when they started early last year. They thought that the inflation spurt was simply reopening the economy after the pandemic and the and the problems with supply chains.
Now, hang on a second. What have you got there? Is that like a candy bar wrapper? Or
It's a Swedish fish.
all right, now put the
upstairs.
Swedish
I like
fish
those.
down because we hear that
Okay,
crackling
all
on the
right.
air. So, what do you think about Jamie Dimon's warning? I mean, 7% may be just a number that he picked out of the air when he was talking in an interview to the Times of India. Who knows where he got that number? But we all thought that at the most, the Fed is going to like 5 3/4, and now all of a sudden, everyone's talking about 7.
Well, interestingly enough, we've done a lot of work over the years. We just updated on what we call a debt bomb. And that is the question of what is the rate at which the interest on the debt, which of course is part of the deficit, becomes so great that the whole thing grows geometrically and blows up. Now, the interest rate on the federal debt now is under 3% because a lot of it's short term. But of course, it rolls over in time at higher rates. So if we stay here, it could be a problem, although our numbers show that unless you got 8% on the federal debt.
The average 8, and we've never been there, right? Because I remember reading...
average maturity is only 6 years. So until you got to 8%, you probably didn't have a problem. But we've never had that problem. We've never had a debt bomb. The closest we had was 1992, when interest in relation to GDP was 3.1%. It's now 3%. It's basically the same. So we haven't been there. We're not Argentina. But you know, this is obviously a concern because if interest rates are up and stay up, of course, there's a lot of other things you worry about. I mean, you know, the economy, I don't think could stand anything like 8% interest on the federal debt because you'd be talking about double digits for everything else, and we haven't seen that since the Volcker era and the ensuing collapse.
Well, now there's a lot of things you've done in your career to become such a famous economist. Probably the biggest is you're a bond bull, and were for throughout the bond bull market, and you know, really made your name with those calls. How painful then has this drop in price, run up in yields been for you? And at what point do you say, okay, now it's time to buy again?
Yeah. Well, obviously, when you've had a long-term forecast, and you might recall, Matt, when I said in 1981 that we're entering the bond rally of a lifetime, the yield on the 30-year bond was 14.6%. It was a long time ago. Obviously, it came way down. Now it's rebounded with all other rates. I think we're getting close because the economy simply cannot stand these kind of rates. We're close to, or maybe already in a recession. It's always up to the National Bureau of Economic Research to make that call. But I think that will do it. And of course, you get a recession. What happens? You get less demand for high quality credit. You get the safe haven of the treasuries. You get the Fed easing. But I think the Fed is going to be slow to ease because they want to make sure that inflation is killed and killed dead. They really are. We're so far behind the curve on this. So I think this whole thing is going to get stretched out. But I don't think we're quite there yet where I will go out. We in our portfolios we manage, we do have some long bond positions, but relatively small. We're not adding to them right yet.
Is there irrational investor exuberance back in this market?
Well, it sure is. I mean, if you look at example at the FANG index,
Yep.
Growth stocks. Now, to the extent that their prices today are the discounted value of future earnings out 5 or 10 years, those things ought to be in the tank. Now they've sold off a little bit lately, but I mean they've rallied for most of the year, and of course this is a big thorn in the side of the Fed because they see investors really not believing them. They just don't really believe that they're serious, because if they did, you'd see a lot of things like this. You'd see stocks in general, and say the FANGs, the interest rate sensitive, housing already affected by interest rates, but investors in terms of securities not yet convinced.
So you think, or I guess, do you think that there's really risk to the stock market in general?
Oh yeah. Early last year, I said I thought we'd have a 30% decline peak to trough. We were down 25%. You got a rally. That means from here you need about a 30% decline. And yeah, I think there is big risk. I mean, you look at all the indicators. You look at the leading indicators. You look at the yield curve. You look at small business hiring intentions. It's just a whole host of factors. And boy, if this doesn't tell you recession and all that goes with it, including Fed ease, a lot easier, a lot lower rates, you got to throw out all the history books.
I would think so too. And, I have a laundry list of all of the headwinds and all the problems that consumers are facing. And you've got, along with that, this strike, which could be bad for the economy, and also inflation, government shutdown, which doesn't augur well. Student debt coming back, delinquencies on credit card debt and auto loans.
Yeah.
Every time I run this list by a bull, he'll say, hey, unemployment is at 3.8%. As long as we have jobs, it's no big deal.
Well, one of the real issues here, Matt, is that employers spend so much time and energy hiring people that they're very reluctant to lay them off. It takes time to shift gears 180 degrees, but of course, as profits and sales weaken, that's what happens. They get layoffs. But this is one of the reasons I think this whole exercise is going to be stretched out. The other one is the Fed taking their good sweet time to shift to ease because they want to make sure that inflation is really.
But that could mean a deep recession, right? If we have, that could mean a very deep recession. If we have the kind of slowdown where, companies have been not wanting to fire people, but are all of a sudden then pushed to do it, and then the Fed doesn't want to come in and cut rates until the economy is really in trouble, that could mean a big, deep drop.
I think it means a long recession, but not necessarily deep. To get a really deep recession, you've got to have a major financial crisis. That's what happened with the dot-coms in the late 1990s, and of course that's what happened with the subprime mortgages.
The Great Financial Crisis. Looks like there could be the beginning of that happening in China right now. Does that
deep as opposed to long, or you got to get a huge inventory correction?
Well, does the Chinese property problem worry you, or are we too insulated from that economy?
Not that much. I mean, our trade with China has atrophied. It does mean that China's internal growth is going to be weak. But you look at Xi, who basically is president for life. He doesn't really care about the well-being of the average Chinese, only that it's good enough that the regime doesn't get tossed out. But they're in a different world. I mean, we look at it through Western eyes, where growth is good, but they don't look at it. Staying in power is good as far as they're concerned. So I don't think that China really cares. And of course, they got the property problem. They got overbuilt infrastructure. They got huge debts as a result of this, particularly at the provincial level. Well, I think China is basically going to be in its own sphere. Now, one thing that does come out of this is China's growing more slowly. It's the second largest economy in the world, and it's a stage of growth where it's more emphasis on goods than services. As economies mature, they shift to services, and when you're in goods, you need commodities. So I think that's weak in commodities. Obviously, is very differentiated. The stuff that goes into electric cars it's kind of in its own world. But you look at copper. Copper's my favorite. I like copper because there's no cartel on either the supply or demand side, and it goes into almost anything manufactured. I mean, again, full disclosure, we're short copper in portfolios we manage.
You're short copper?
Yes.
That's no bueno. Why are you short copper?
Well, because because that's a bet on global manufacturing weakness.
Yeah.
Plus the fact of the sake.
He is a bear.
I mean, you look at OPEC. You can have a great forecast on oil, and yet OPEC Plus comes out tomorrow and makes some announcement, and you're really in trouble.
All of a sudden, we're looking at $90, $100 barrels.
Yeah.
Gary, great having you in the studio. Thank you so much for coming in. Gary Shilling.
we just turn them on and we can just sit here and listen all day.
Yeah, well, I do that sometimes on the weekends.
On the weekends. Oh,
Yeah.
okay, very good. All right, Gary, thanks so much for joining us.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's check in with our next guest right here, Tim Dewey, Chief U.S. Economist for SGH Macro Advisors. Tim, I'm not sure if you heard our last discussion. It was with Gary Shilling, and he was bearish, right, Matt?
Well, he is obviously, one of the most famous bears on Wall Street.
Exactly.
A lot of what he was saying reminded me a little bit of what I've heard from Jeremy Grantham as well, who is, obviously uber bearish. But I have to admit that I have that appeals to me because I see so many headwinds in this economy, Tim, and the exuberance that pushed us up to 4,500 on the S&P just doesn't make sense to me as the Fed's raising rates 500, 600 basis points. How do you see it?
I'm a little bit more optimistic than Gary Shilling. I'm not quite as bearish on the economy. I tend to be much more optimistic that the economy remains more resilient than people give it credit for, and that's a big reason here why stocks have performed better than I think anybody would have anticipated in this cycle. Given, as you said, the Fed raised rates over 500 basis points and is threatening the even possibility of even more. But I think that just really reflects that the economy is at a fundamental level different and stronger than people have really, I think, been willing to contemplate.
Than ever before in history, right? I mean, when's the last time the Fed was able to raise rates 5 or 6% without causing a recession?
It's a big shift, right? And so plenty of people pointed out to indicators over the past year and a half that would all point to a recession, and so far, that recession just hasn't materialized. And again, it just, I think, speaks to a very different economic environment than we've been familiar with.
So, I mean, for better or worse, Tim, on my personal agenda, I've taken recession off the table several months ago, but was I a little premature there? Is that still really potentially in the cards here?
Well, so eventually, right? I mean, this is the stop clock argument. Right. Is there's always going to be a recession sooner or later. Yeah. But I think you were wise to take it off the table several months ago, because clearly, I think the predictions that we would have a recession by this time, just haven't materialized, and I don't really see one coming, anytime soon. I think there's still some momentum under this economy, and that momentum's not going to fade very quickly. So I really, I don't have a recession in the forecast because, it's such an idiosyncratic event, and that's what keeps tripping people up. Is that every recession is a little bit different. The indicators that lead you into that recession are a little bit different every time. So, we really, I think, don't have a lot of visibility on when another recession is going to occur.
And it's a big and diverse economy. Who is it? Ed Yardeni has said that he thinks we're in kind of a rolling recession where different pockets of the economy are hit at different times. You're not just the chief economist at SGH Macro Advisors. You are an actual doctor in economics. I mean, you have a PhD and teach courses on this and, help to guide the economy of the state of Oregon, as far as I understand it. What do you think of that idea, rolling recession? Some states are going to have problems. Some industries are going to have recessions, whereas, we don't see everyone having a uniform recession. Doesn't that make sense?
Oh, it makes a lot of sense. I mean, we sort of forgot. I mean, during the immediate aftermath of the pandemic, when everything was booming, right? Everybody was doing well. That's really not the norm, right? If you have a slower economy, it's still solid, but slower economy. you have sectors that are up versus down, and that's just that's just part of the natural give and take, I think, of the economy. You can't expect everything's going to be cruising along at a high speed, and of course that makes it more difficult to assess, if you're going to fall into a recession or not, because again, one industry sliding, if say this industry always slid during or prior to a recession, then you turn around and you find another industry that had always slid prior to recession, but now is gaining traction, right? And so you kind of say, well, wait a second, what's going on here? And what's going on here is that you don't have a economy-wide shock that is really driving firms to cut investment and cut employment in a very synchronized way. And until you can get that kind of shock, that kind of momentum, I think it's really hard to create a recession in the economy.
That's kind of where I want to go. This labor market, Tim, just kind of fascinates me. I've heard the term hoarding of employees, and I've never heard that before. What do you make of a 3.7% unemployment rate here in this economy?
So certainly it was during the case of the pandemic that labor was so hard to get, you didn't want to let it go. I think that firms, if they had the sort of economic conditions that drove the need for layoffs, they would react quickly. So the labor hoarding story only takes you so far. And remember, last winter, around the turn of the year, we saw so lots of layoffs in the tech industry. So even though that had been an industry that had struggled immensely to hold on to labor during the pandemic, once it was ready to shed labor, it shed labor. Now that story, I think, is past us already. So for me, again, when I look at what happens to the unemployment rate typically in a cycle, it falls to some level like this, say 3.5% to 4%, somewhere in that range, and it just sort of hangs out there until you can get again that massive negative shock that really pushes you into another direction.
Hey,
so.
Tim, I just want to jump in because we are looking at pictures of President Biden on the tarmac with UAW President Shawn Fain and some other union members. And while we're speaking about labor, I might as well bring up this because I think we've seen a really fascinating shift in the power dynamic between labor and the corporate bosses. This may be coming to a head now as the UAW is asking for 36% wage increases, bringing back pensions. They want a 4-day work week. They want to know what the production schedules are at these companies. And I wonder what you think, what kind of effect this is going to have, because on the one hand, if they stay on strike, I would think that they're going to drive up the cost of cars even more, and they have barely recovered from the pandemic in those terms. On the other hand, they're going to boost wages for at least 150,000 workers and probably more who look over and say, I want that deal too.
Yeah, no. So on the one hand, at least the near-term issues, you're correct. I mean, we're counting on lower car prices and lower used car prices certainly to help on some of the inflation front. And if we cut off supply now, again, that's going to delay that. There's really large, I think, strong pent-up demand for automobiles already, and that's one reason auto sales have in fact held relatively high despite rising interest rates. So that's clearly a near-term hit for the economy. The interesting thing, and I really like what you just said on the wages, is that to what extent does this become a signal for the rest of the economy, right? Is that if auto workers are getting huge raises, and we've seen huge raises in other industries, to what extent does that make other workers expecting a higher wage? So instead of expecting 3% a year, now they're expecting 5% a year, and then how does that work its way into inflation expectations? And you can tell a story where a series of negative shocks or those kinds of shocks really do, create a different inflation environment than we had in the pre-pandemic period.
All right, Tim, thanks so much for joining us. Really appreciate that. Tim Dewey, Chief U.S. Economist, SGH Macro Advisors, getting his thoughts there. A little bit of a different spin than what we heard from our good friend Gary Shilling.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.